Let us go back in time to the year 1950 when a 19-year-old boy in the US, he had just finished reading an investment book and he was bubbling over with excitement. He felt that he had just read the best book on investing ever written. Cut to 75 years later, this boy is now an elderly gentleman of 95 years of age. And the interesting bit is he still thinks that the book he read as a 19-year-old remains the best book on investing ever written. And this time we have reasons to believe him because using the techniques and the principles outlined in the book, he has gone on to build a fortune in excess of $140 billion and is one of the richest men on the planet. If you haven't guessed by now, I'm indeed talking about Warren Buffett. And the book that he has referred to or is referring to is The Intelligent Investor by Ben Graham. Now, the book is a personal favorite of mine as well. I have a copy of book lying at my office desk all the time, and I refer to it from time to time. In fact, I make it a point that I go through the book cover to cover at least once every few years. So, it's my personal favorite as well. What is so special about this book? We'll let Warren Buffett answer this. I think he's put it very eloquently, the key takeaway from the book, and here it is in front of you. To invest successfully over a lifetime does not require stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. I think he just nails it. Investment frameworks are very, very important. If you're still thinking, what does it take to be a successful investor, whether it's IQ, whether it's business insights, whether it's inside information, of course, legal inside information, these things matter. But according to me, and according to Warren Buffett also, of course, you need a framework. Without a framework, you will be lost. In fact, as lost as Virat Kohli was in the recent India-Australia tour. So you need a framework, and without it, you cannot function. You will be totally lost. Now, what exactly is a framework? It's simple. It's buying and selling rules. You have to decide in advance what will be a buying rule, what will be a selling rule, the portfolio rules. Just to give you an idea, this is the Warren Buffett framework, 4 simple filters. This is a permanent fixture in any of his writings. I mean, the annual letters that he writes to shareholders or any other communication, he talks about these 4 filters. Very simple. Do I understand the business? Does the business have a moat or a competitive advantage? Is the management team trustworthy? Is the business available at attractive valuations? I've been tracking Buffett's investments for the past many years, and I don't think he's ever made an investment where any of the companies have not followed any of the rules. He is very particular about this. He follows it to the T. And I think that's why he's so successful, because of his discipline in following this framework. He has a framework and he sort of sticks to it. There are other frameworks as well. Peter Lynch also had a framework, not as simple as Warren Buffett's, but he definitely did operate from a framework. Then there's Walter Schloss, who was Warren Buffett's close friend, and he had the simplest framework. I think he invested for around 65, 70 years, and all he did was buy companies which were trading below book values. I don't think there's ever been a time where he has invested in a company which was trading below book value. He kept it very simple. Always invest below book value, never above book value. Now, the interesting thing about these 3 gentlemen is that, in terms of temperament, in terms of their approach towards investing, they were completely different. Warren Buffett, he keeps saying that you should read 500 pages per week. You should put in a lot of hard work. But he does not meet managements. Peter Lynch met management, toured the country, met a lot of investors, different approach. Walter Schloss was the least hardworking of the 3. He worked for 4-5 hours a day, just scarring through balance sheets, and he was still, successful. The reason these 3 people were so different and still so successful was because they had a framework of investing and they stuck to it. And that is the power of framework. If you don't have a framework, create a framework and then stick to it. Ensure that it's a sound framework. Now, what happens if we apply the power of framework to Indian stocks? This is exactly what I did. What I did was a small exercise. I went back in time to December 2014 and created 10 different portfolios using 10 different frameworks, very simple frameworks, and then tracked the performance over the next 10 years. And this is the result I got. Even I was surprised with the result, but it is what it is. 10 portfolios, out of those 10, 8 have managed to outperform all the 3 indices, BSE Small Cap, BSE 500, Sensex. Every rupees 100 invested in the BSE Small Cap Index gave you rupees 500, but the best performing portfolio gave you 1100, second best gave you 1000 rupees, the third best gave you around 900 rupees. Only 2 portfolios, portfolio 9 and portfolio 10, they sort of underperformed the BSE Small Cap Index, otherwise they outperformed the 500 and the Sensex. Simple framework, nothing fancy, but applying it with discipline is what all I did, year in and year out. For those who understand the CAGR language better, the returns in CAGR forms, the best performing was portfolio P3, 27% CAGR, P2, 26%, P1, 24%, and so on. The underperforming ones, P9, P10, 15% and 13%. And the BSE Small Cap Index, of course, highlighted there, 17% CAGR. So 8 out of 10 portfolios, managed to outperform all the 3 benchmark indices. So I'll spend some time on this slide. This is the rules that I followed while creating those portfolios. Very, very simple rules, nothing fancy. There was a selling rule, sell after 1 year. So what you do is, start of the year, you buy equal weighted portfolio of 20 stocks and sell them after 1 year. At the end of the 1 year period, again buy 20 stocks and again sell them based on the same criteria. Then there's the buying rule. Buying rule is further segregated into valuation rule and other rules. In terms of other rules, only 4 rules I followed. Each of the company that enters any of these portfolios should have a positive EPS in each of the last 5 years, a revenue of at least rupees 2 billion, a debt to equity ratio of between 0 and 1, and a liquidity of daily average liquidity last 1 year of at least 10 lakh. So this is the other rules. And then there's a valuation rule. The only difference amongst all these 10 portfolios is the valuation rule, where portfolio 1, all the stocks that come into portfolio 1 should follow the rule of having a price to book value of between 0.3 and 0.8 times. No single stock enters this portfolio if it does not have price to book value, and this is for all the 10 years, all the 20 stocks. P2, same thing, but the difference is that this time I've followed a price to earnings rule of between 5 and 10, P3 between 10 and 15, P4 15, 20, and so on, all the way to P9 and P10, P ratio of between 40, 45, and 45 and 50. So these were the simple rules, nothing fancy. Now, I'm sure you're asking, there's a doubt in your mind, why these rules and why not any other rules? Why not consider things like ROE, ROCE? Growth is very important, earnings growth. I've not considered earnings growth as well. So why these rules and why not any other rules? The simple answer is these rules have been created to suit my style of investing, to suit my taste. And that's why those rules are there. Now, what exactly is my style of investing? Before that, let us have a look at the performance again. This time what I've done is on the x-axis. I've also given the PE range so that you have a better idea of which portfolio has done how well. So the best performing portfolio was the portfolio that I had a PE ratio between 10 to 15. That did the best. Close second was P2, which had a PE ratio between 5 and 10. And the third best was P1, the price to book value portfolio, which gave 9x returns. And the worst performing were P9 and P10, high PE stocks, which underperformed the BSE Small Cap Index, but did manage to have a slight outperformance over the other 2 indices. So going back to that earlier question, why these rules and why not any other rules? My answer was the rules were there because I wanted to follow my style of investing. And what exactly is my style? This is the CAGR. Just a colorful metaphor here. Are you a squirrel investor or an eagle investor? And what is the difference? I think investors can be classified broadly into these 2 categories, squirrel investors and eagle investors. And you know, going by the personality of a squirrel investor is also, cautious. He prioritizes safety and risk aversion and always has a survival first mindset. An eagle investor, on the other hand, has powerful vision. He is constantly seeking new hunting ground and challenges, and he has more of a growth mindset. So which category you think you fall into, squirrel investing or eagle investing? Now, if you still have difficulty deciding, let me tell you about three of the greatest investors and their investment philosophy, or what kind of an investor they are. The first quote is from Warren Buffett, and his most favorite rule is that there are two rules in investing. Rule number 1, do not lose money. Rule number 2, always remember rule number 1. The second happens to be the late Charlie Munger, whose motto was avoiding stupidity is easier than seeking brilliance. And the third is from Howard Marks, where he says that if we avoid the losers, the winners will take care of themselves. Now, if you harbored the thought that all these three guys were eagle investors, because they are so rich and they are so learned and they constantly keep seeking new challenges, well, you can put those doubts to rest, because they are not eagle investors, they are squirrel investors. They are all about survival first. As these quotes suggest, survival is very important, risk aversion is very important, and going by the activities, the investments that these three gentlemen have made in the stock market, and going by the quotes, it's pretty clear that they are squirrel investors and they are not eagle investors. Now, another word for squirrel investing or squirrel investors is, of course, value investing. So squirrel investors are value investors, and it will be fair to say that eagle investors are more sort of growth investors. Another way of highlighting this difference is, when you buy a stock, typically 4 things can happen. You either make big gain, you make small gain, you make small loss, and you make a big loss. Now, our job as value investors, of course, I'd also like to call myself a value investor, is to focus on the left-hand side of this chart, where primary goal has to be risk aversion, safety first, and try and avoid the big losses in our portfolios. That should be our primary goal. These guys, value investors, they don't care about their winners. All they care about is trying to minimize the downside, trying to take care of the losers, because they are of the belief that as long as you take care of the losers, the winners will take care of themselves. You don't have to worry about the winners, focus on the losers. The guys on the right-hand side who focus on the right-hand side, big gain, growth investors, their focus is, I need those few multi-baggers in my portfolio. I need a 5-bagger, I need a 10-bagger, I need a 20-bagger. I don't care about the losers. Losers can go all the way to 0, that's fine, but I need those multi-baggers in my portfolio. Now, interestingly, I had thought of a brilliant passage from Intelligent Investor for this slide. And coincidentally, I realized that Mr. Rajiv Thakkar of Parag Parekh Fund, whom I respect a lot, I think is one of my favorite investors. He's also quoted the same passage or the same explanation from the book in his recent letter to his unit holders. And that quote goes something like this: the experts do not have a dependable way of finding and concentrating on the most promising stocks in the most promising industries. I'll repeat that. The experts do not have a method of finding and selecting and concentrating on the most promising stock in the most promising industries. Now, what he's essentially trying to say is there is no framework for growth investing. At least, I haven't come across one. There are plenty of frameworks for value investing, but to find multi-baggers on a consistent basis, according to me, is very difficult. You can, of course, have the odd multi-bagger in your portfolio, but to do it on a consistent basis, to find the 5-baggers, 10-baggers, 20-baggers on a consistent basis is very, very difficult. You would rather focus on minimizing your downside and allowing the winners to take care of themselves. That, I think, is more important, according to me.